The markets are quiet, but the silver data is not. Behind closed doors this weekend, something has scared the biggest players into secret meetings. We are seeing the same strange signals that showed up before past metal shocks. Thin inventories, sudden rule changes being drafted, and price models that stop making sense if silver jumps anywhere near $80. If these risk meetings go wrong, it won't just hit traders, it could hit savings, pensions, and the cost of everyday goods that depend on silver. In this video, we're going to follow the money, trace the weekend calls, and ask why they are suddenly so afraid of a metal most people ignore. Stay with me to the end to see how an $80 silver move could ripple through the whole system and what the clues are already telling us. If you want more deep, honest breakdowns like this, subscribe, like this video, and share it to support the channel so we can keep digging into the stories they don't want in the spotlight. The first clue does not come from a headline. It comes from the timestamp. Big banks and clearing firms usually slow down on Friday night. Yet this weekend, trading logs show sharp bursts of activity in silver futures during hours that are normally quiet. Phone records and messaging traffic, where we can see them in public filings and audit trails, show another odd signal. Compliance notes marked off-cycle review, pricing stress, and liquidity check, all clustered late Saturday. That kind of language is not used for routine work. It usually appears when risk teams are told to rerun the numbers in a hurry. In past crises, like the 1998 LTCM blowup, the real action also started on weekends, when doors were closed and central bankers met behind the scenes. Markets opened on Monday looking calm, but the decisions had already been made. The pattern is simple. When powerful people are afraid, they meet when the public is not watching. Order book data adds another fracture. Bid and ask sizes in key silver contracts briefly thinned to levels more common on holidays, even though price barely moved. It is like seeing a crowded theater suddenly develop empty exits just before someone shouts, "Fire!" Who called this a parent emergency meeting, and what did they see in the silver data that could not wait until Monday? The answer matters, because these hidden weekend signals are often the first step in a chain that leads to fast, violent price moves. That is not how a normal, relaxed market behaves, and they now point straight at the growing risk of an $80 silver shock. Beneath the calm weekend prices sits a problem that has been building for years. Too many promises to sell silver that may not be easy to find. In the futures market, a small group of big players hold very large short positions. That means they have bet that silver will stay low or fall as long as price moves slowly. This is like juggling knives in a quiet room. But when price jumps, one slip can cut everyone. Regulators have warned about this before. In past reports, the CFTC showed that just a handful of banks controlled a huge share of the silver short side. A similar pattern appeared before the 2010 to 2011 run-up, when shorts were forced to cover as price rose, adding fuel to the move. Now a new fracture appears. Registered inventories on major exchanges are trending down while open interest stays high. It is like selling more and more tickets to a concert hall while quietly removing rows of seats. Most of the time, no one notices. Trouble starts when too many people ask to sit down at once. The red flag this weekend is a spike in margin adjustments and risk notices linked to these large short books. Somebody is nervous about how quickly losses could grow if silver breaks higher. Yet we do not know which firms are closest to the edge or what private deals they might be making to hide that stress. This links back to the emergency weekend activity. If key players fear a short squeeze toward $80 silver, they have every reason to meet in secret and search for ways to slow, shift, or contain the blast. While traders watch charts, central banks watch maps. Every new conflict, sanction, or military buildup adds a quiet war premium to key resources, and silver is one of them. It is used in guidance systems, drones, satellites, and solar panels that power bases and data centers. In a more hostile world, this metal stops being just an industrial input and starts looking like strategic ammunition. History shows this shift clearly. In the late 1960s, as war costs and inflation rose, the United States pulled silver out of its coins because demand was too strong and supply too tight. Gold took most of the headlines, but silver demand was quietly driven by both industry and fear. Today, we see a rhyme. Central banks are adding record levels of gold, while defense budgets and energy transitions are raising silver use at the same time. It is like tightening both ends of a rope until the fibers start to snap. The anomaly now is the mismatch between official stories and trade flows. Central banks rarely admit to buying silver, yet customs data in some regions shows unusual shipments to state-linked firms and defense contractors. At the same time, sanctions are pushing some countries to look for assets outside the dollar system. The open question is simple. Are some states using front companies to build hidden silver stockpiles, just as they quietly did with gold in past decades? This matters for the $80 path. If governments view silver as a strategic asset, price caps and paper shorts start to look weak, like sandbags against a rising river. Just as earlier signals hinted, a geopolitical push could collide with the fragile short positions and weekend panic we have already seen. Most people only see the paper price of silver on a screen. That number comes from futures and large funds, not from coins in a dealer's safe or bars in a vault. On weekdays, the paper market usually controls the story, but when stress builds, The physical market starts to speak louder, and the gap between the two becomes a warning signal. It is like writing more and more IOUs for cars, while the parking lot slowly empties. History shows how this split can appear before a sharp move. In 2008, during the financial crisis, futures prices for both gold and silver dropped hard, yet coin shops reported shortages and long wait times. Premiums over spot price jumped because people wanted metal in hand, not just a promise on paper. A softer version of that pattern appeared again around the 2011 silver spike. The paper price moved one way, but physical demand refused to follow. Now a new irregularity is building. Some silver ETFs report falling holdings, while exchange warehouse stocks decline at the same time. Normally, if investors are selling paper silver, more metal should sit untouched in storage. Instead, metal is leaving. Dealers in several regions also report higher premiums and slower deliveries, even when futures suggest plenty of supply. Something in the chain does not match. The open question is, who is taking this metal out of visible pools, and why do they prefer bars you can touch over cheap paper claims? Just as earlier signals hinted, this quiet drain of physical silver limits how long large short positions and calm weekend meetings can hold the line if fear flips into a rush toward $80 silver. To see where this weekend panic might lead, it helps to look back at the two loudest silver shocks in modern history, 1980 and 2011. Both times, the data turned hostile long before the headlines arrived. In 1980, the Hunt brothers tried to corner the silver market. Prices blasted from around $6 to nearly $50 an ounce as they bought futures and physical bars. Exchange inventories shrank, and short sellers faced rising margin calls. Regulators responded with sudden rule changes, including liquidation-only orders that stopped new buying. The move was like slamming a door while people were still running through it. Silver crashed, and many players were wiped out. In 2011, the pattern rhymed, but with different actors. After the financial crisis, money printing, debt worries, and distrust in banks pushed investors into metals. Silver again shot near $50. Then came another series of quick margin hikes and trading limits. Once more, forced selling flipped a sharp rise into a violent fall. Today's anomaly is how similar the pressure points look. High leverage, tight visible supply, growing distrust, without any public sign of new rules yet. It is like watching dominoes line up without knowing who is holding the last piece. The open question is, what exactly was discussed in this latest weekend meeting? Are new position limits, margin shocks, or trading halts sitting in draft form, waiting for the next surge? Just as earlier signals hinted, the echoes of 1980 and 2011 suggest that if silver charges toward $80, the battle will not just be about price, but about who controls the rule book when the storm hits. Every price spike has victims, and the silver market already shows signs of who could be trapped if price runs toward $80. Public data from futures reports and bank filings point to a small circle of too important to fail institutions with very large short and swap positions. These are mainly bullion banks and global dealers who make markets for miners, mints, and hedge funds. When silver is calm, they collect small fees. When it jumps, their books can bleed fast. A useful historic guide is the 2013 gold crash. Back then, a few big banks held large, complex positions. When gold dropped sharply over 2 violent days, some funds were forced to liquidate, and banks scrambled to hedge. Later reports showed heavy losses and quiet balance sheet repairs. The pattern was clear. Concentrated exposure turned a market move into a balance sheet event. The red flag today is the mix of large, opaque, over-the-counter silver derivatives and rising options activity betting on higher prices. It is like watching dry brush build up around a campfire. One spark, and the flames move faster than anyone planned. Industrial users, like large solar firms, may also be short through hedges. If price runs away from them, they must choose between paying more or cutting projects. And behind them sit states that might have guaranteed or encouraged some of those contracts. The open question is which balance sheets sit closest to the blast zone? Which banks, which funds, which state agencies? Just as earlier signals hinted, the more trapped these players feel, the more likely they are to push for weekend meetings, sudden rule changes, and any tool that might slow or cap an $80 silver surge. The road to $80 silver is not a straight line. It is a chain reaction waiting for the right spark. One clear path begins with a break above recent price ceilings that triggers stop-loss orders on short positions, forcing banks and funds to buy back contracts at any price. Another path starts in the physical market, a sudden jump in delivery requests or a mine disruption that exposes how thin real inventories have become. History shows how fast that kind of move can unfold. In 1979 to 1980, silver and gold both went almost vertical in a matter of months. Once trust in money and supply discipline cracked. More recently, in 2022, nickel on the London Metal Exchange spiked so violently that the exchange canceled trades and rewrote the rulebook to protect a trapped short. The anomaly today is how calm volatility indexes still look compared with these growing stress signals in inventories, options, and weekend meeting leaks. It is like seeing storm clouds on the horizon while the local weather report still shows partly cloudy. If $80 is reached, the aftermath would not stay inside the silver market. Industrial users could face cost shocks, some hedges might fail, and faith in paper metals contracts could weaken, pushing more investors toward physical bars and coins. The open question is whether regulators and central banks would again step in through margin hikes, trading limits, or even temporary closures to slow or reverse the move, as they have done in past metal crises. Just as earlier signals hinted, the choice they make at that moment will reveal whether this was a controlled release of pressure or the start of a wider loss of confidence in the system itself.